Hey guys, welcome back to Results Junkies podcast. Mr. Singh and I are sitting here both in the same state for once in quite some time. And we're taking the wraps off of something that Paul and I have been discussing in the background for, I'd say, a number of weeks now, Mr. Singh, but we're talking a number of months.
Yeah,
How you doing, man?
I'm good, man. I'm good. I don't have quite as crazy a travel schedule as you, but went down to Florida last week, amongst other things, to deal with some banking issues, which we can talk
Mm-hmm.
about if you want. And then, yeah, we're pulling the wraps off on a new thing that we did. I don't want to take away the thunder until you're ready, but by the time this episode goes out, it will have already been announced. But things are good. You know, the kids are in their groove of school. They're already asking when the next Disney trip is, and I said, you got to go ask Uncle Ed.
Right. The next Disney trip will be the day after this episode drops, and then again in 3 weeks if you're a good dad like me.
Oh man. I was doing something over the weekend. I was kind of working on my list or whatever. And at one point Dana was like, "Hey, I need a minute. I'm texting Ed." And I just know that whenever she's on the separate text thread directly with you one-on-one, I know it always costs me money.
Yeah, well, yeah, and a lot of money too, because she's talking
Yeah.
about holidays at
Oh
Disney,
man.
and she was like, "Gosh, I'm really sorry to be texting you on a weekend," and it's like, no, like unlike your husband, I work on the weekends.
Harsh. Harsh.
Yeah, well, look, we're only 2 minutes in, and we got the first dig, so we're in good pace. A little bit of housekeeping before we take the wraps off of what Paul's been working on for the past few months. Show at resultsjunkies.com is how you email us questions and comments. If you're watching the show on YouTube, love it if you'd like this episode, a little thumbs up, and then subscribe to the channel. Same thing on any audio channel that you're listening to. Liking and subscribing is a big help for us. On social media, you can find him at Paul Singh, and I am at Pizza in Motion on all of those same platforms. So just to set things up for the audience, Paul has been messaging me in the background for probably about 3 months now, and I don't know what the actual start of this was, but the genesis of this was you've sort of woven through this path of fundraising in, I wouldn't necessarily say it's the most difficult time in the time that I've been involved in venture investing, but it certainly is one of the more challenging times for sure. And I think, I've asked a number of times before we start the episodes each week, can we talk about it yet? Can we talk about it yet? And so, Paul, I will ask you, can we talk about it yet?
Yes, we can. Yeah. So this week we announced, for those of you that don't know, so I'm the CEO of a company called Strata PT. And, we've been bootstrapped, profitable, sort of check all the boxes. And I'll tell you as much as you want to know, but the gist of it is we're announcing this week that we just closed up a $25 million round of financing, and we're stepping on the gas in a big way. But yeah, I've been texting you for a while now, just kind of getting some outside opinions because, when you're when you're in the operational role and you're sort of, drinking your own Kool-Aid, it's good to have sort of a third party, view on things. So despite the fact that I get a dig from you about every 7 minutes, it's nice to have somebody that is sort of arm's length, has no skin in the game, that can kind of be like, Paul, that's dumb. This is great. Don't do that. You should absolutely do that. So let me pause there. Let's dive in anywhere where you want. I will say I'm a little uncomfortable because I always hesitate when people try to make financing news, because it's sort of like this big vanity thing. So if you sense any discomfort, it's not that I'm not excited. It's just that I always cringe when people are like, look, guys, we raised all this money. And you're like, okay, but that doesn't really mean anything. What's next?
Yeah, yeah, no,
So
I get that. And I think, from my standpoint, I think like some of my questions are probably a bit more on the tactical side of things where we like to focus on the show. And I think, I think one of the things that I ask, which I already know the answer to, obviously, because you and I have talked about throughout the process, but I think it'd be really helpful for the audience to understand this. In your estimation, how long ago do you think was the first time that you texted me and said, I think we're going to close in the next, call it week, and how long after that until now? Like, I feel like you had a number of moments where you really felt like you guys were on the 1 yard line, and came to find out that you were on the 10 yard line or the 20 yard line.
yeah, well, so okay, this is a good question. Let me kind of back up for a minute here. I think the thing is that let's start with the elephant in the room, which I think is going to not make anybody very happy. So for any of the entrepreneurs listening here, here's the part you're not going to want to hear. It turns out, despite what a lot of people tell you, fundraising isn't all that difficult if you're, if you've got a business that's working. Now don't misunderstand me here. Like fundraising is always hard. But it's hard in the sense of like trying to optimize, get the right paperwork in the right, say the right thing and all that. But there's no shortage of capital for companies that have some sort of product market fit. So that's maybe the uncomfortable part to start. I would say high level summary. Okay, so we probably started talking about doing this internally maybe 6 months ago. Hey, should we do this? We've got something working. We started looking at our own growth rates and we're like, huh, okay, well, we've done this bootstrap. That's cool. What can we do with outside money? I would say, so that was probably January, February of this year. I would say just off the top of my head, somewhere in April or May is when we got serious about doing like the rounds, talking to various, investors and things like that.
Mm-hmm.
And if I'm not mistaken, it was probably around May when we got around to signing our term sheet. Or maybe it was June. Maybe it was like June. We signed our term sheet, but it was right around that time when I was starting to text you for some outside, unaffiliated advice. And then we thought we would have closed by the end of July, and then that pushed into maybe the latter half of August. So I would say I probably started texting you. I text you probably every day, but I would say I probably started texting you about this around May or June as we kind of started to circle into the top three-ish term sheets.
Mm-hmm.
And then, from there, yeah. So that was a long way of just saying, I think it was probably May or June is when I first started asking you about it.
Yeah, and I think, one of the things that you had with this was trying to balance a number of different, competing priorities. So you obviously, as you've noted, you had to figure out who you guys wanted to align with from a funding standpoint, and then you had your internal partners in the company to sort of align with as well, and you probably had to talk through this story of what the future was going to look like. So explaining the story to an investor as to why they should be investing in Strata and what next was going to look like.
Well, yeah. I would say yes to all that, but I'll just speak on a personal note. This is the first time I've been on this side of the table at this level.
Yeah.
So what I mean by that is that historically, I'm on the investor side of the table.
Sure.
And I don't feel the pain. I think in one of the things that I've sort of come to respect in this particular process is that from the other side of the table, you don't really see all the inner workings. Everything that you just described there, you don't really see it on the investor side because by the time, they show up, they've probably already come to some agreement. They kind of already know like what they're doing and all that. So this was, I would say on a personal note, the more uncomfortable part was just sort of knowing that, especially at this check size, I had not been on this side of the table. So, seeing under the tip of the iceberg was, the example I used with somebody else the other day was like, you ever see that like old analogy of like the duck on top? He looks so calm, but underneath like the legs are just going crazy.
Yeah. Yeah.
That's kind of what it felt like. But it's sort of like navigating all those conversations of like, hey, what does it mean if we go down this path, and that sort of thing. So yeah, I'll put color anywhere where you want, by the way. I'll try to stay focused.
Yeah. So I think, when you think about this, and you think about fundraising, and as you mentioned, this is your first time on sort of this side of the process. How different is it than you thought it would be? Like, was it more challenging, less challenging?
I have a lot more respect for it now, and if any of our new investors are listening, I mean nothing bad by this, but I'm the guy every once in a while I'll be like, hey, I'll like text the CEO or whatever, and be like, hey, real quick, can you just tell me this number? Or, hey, can you just throw this in the next board update or whatever?
Yeah.
And you think nothing of it, right? And now I'm on the receiving end of those things. And it's like, ooh, okay, hang on, let me pause. I'm going to need to make a note of that. Let's get that into that deck,
Yeah.
So it's things that I took for, here's the way I would say it. The things I thought would be easy have turned out to be a little bit more difficult than I expected. And the things that I thought would be difficult actually turned out to be a little bit more easy than I expected. Which I suppose is something I say about RVing as well, but that's a different show.
Yeah.
But I think I guess the thing I would just say, because our audience for this show is primarily more entrepreneurs and early stage investors. I guess what I would just say is that like we're talking about a $25 million raise here. And the reality is that it's a little bit different than the 500K raise and the $1 million raise and stuff like that. And so I don't know where this will go, but let me just throw a couple ideas at you. First of all, I have a whole new respect for having a clean set of documents. Like the more that so everybody knows that once you sign that term sheet, there's always a bunch of diligence that has to happen before you get to
Yeah.
the closing. That's not a surprise to anybody. But one of the things I have a huge amount of respect for now is the fact that the cleaner your internal record keeping is, the smoother that entire diligence process is going to go. And nobody tells you that. Like it's kind of like at the early stage, you and I have very little diligence relatively, because it's like, hey, show me the operating agreement, show me 10 other pieces of documents, and then we're done. That's just kind of how it goes at the early stage.
Right.
But at this stage, with a couple $1 million of revenue and a bunch of customers and employees and all that stuff, it's like, where is every employment contract? Where is every, vendor contract? Where every single document? And, big props to my partner, Kim, in the business, who just made it look so easy. Like, even when we got into like our finances and stuff, it's like, I can't remember exactly what the auditor said, but it was like, hey, you're within 1% of actuals. We're like less than 1%, I think, of records were like maybe slightly miscategorized or something like that. So it's kind
Yeah.
of like, it could have been way worse. But if you're an early stage founder right now, do not underestimate how important it is to do your books right and to keep all your records in one place.
Yeah.
Uh,
Yeah. No,
y-
I think you bring up a good point. I think, there's so many companies, and this isn't just for, SaaS founders or startups. And this is, in the restaurant world as well. It's one of those things where, you know, you're by the time you decide you want to get your books in order to get ready for a sale, it's too late. And so you sort of have to go through this process. I call it the continuing evolution of your books. Like you should, like I look through the P&Ls on a monthly basis for the snapshot of the health of our business. But I also try to look at it each month from the standpoint of, if an investor were looking at these, what could I do to make it cleaner? What could I do to make it
yeah,
more
yeah,
accurate, if you will? How would I want these transactions spread? Hey, if I look back a year from now and see this big one, invoice for whatever, how am I going to explain that to someone? How do I footnote it? All those things in the
yeah,
terms of, and I only learned that the hard way when we sold the restaurants for the first time back in like 2006 or seven. Like the books were not accurate, and I had to provide all these footnotes, and you sort of referenced this when you talked about, building the data room, if you will, when you're like, when, they call the CEO and say, hey, I just need that one more number. But building a data room for something like this, if you're not prepared for it, can be a pretty daunting task.
yeah. One of the things I sort of think about recently is that back on the tech tour, we would talk a lot about this idea of there being two stages to any company. So the first being, will it work? And the second being, how big could it be?
Yeah.
And going through this process now, I would say that, once you've hit that transition point between will it work, meaning do 3, 5, or 10 customers, see enough value to pay you. Once you transition into how big it could be, I would say you should probably, that's when you start beginning to get all your records in order. Not because you're building to sell or to get investment or something like that, but because like the more you keep your house in order, the easier it is to just run the business and do what you need to do. So start early. Start early. I mean, I think I can say this out loud. I haven't tallied up all the bills. I mean, truthfully, they were probably already tallied up. I just don't want to look at part of our records. But I would say, just to give you guys a sense of scale, on a $25 million round, I think expenses probably to close the deal were probably somewhere between 400 and 500K.
Yeah. Yeah.
Probably evenly split between us and the investors, because there's
Mm.
stuff that we need to pay for just so that we're protected and stuff like that. So
Sure.
I would say, just to give people a sense of scale, uh, imagine spending about 500K total on a $25 million fundraise just to make sure everything was in, your ducks were in a row. And that's if your deal room's clean.
Right.
Just imagine how much worse it would have been, had it not been, and obviously you can't quantify the stress levels, but those dollars and things like that you're paying to, to attorneys and auditors and consultants and stuff like that adds up pretty quick. So I think I guess my point here though is that there's so much under the radar that we don't talk about in the industry, but there is money out there if that's, if you've got a business that's working. The other thing that I thought was really interesting going through the process is just how sensitively you have to manage customer relationships and employee relationships as well. In our case, it was a little bit, maybe I'm making a mountain out of a molehill here, but like in our case, we had always talked about being bootstrapped. Our employees and our customers understood that, you know, we didn't have a safety net. We used net margin as the safety net, and so I think there was a certain amount of like, angst there that we wanted to manage because I think that particularly in the industry that we're in, there's kind of this bad rap. Like the minute
Mhm.
you raise money, our customers or customers in this industry immediately think the worst, and employees sometimes
Yeah.
think the worst. And so, a big part of, just so you know, one of the biggest reasons why I kind of had to keep this quiet for the last 30 days, like we're recording this now 5 weeks after closing. The
Right.
reason we had to keep it under wraps for so long is that I needed to talk to 40 some employees one on one, explain what this meant to them. But then also we, went out to our top 20, 30, 40 customers, not just by revenue, but also by relationship, and to
Mhm.
say like, hey, just so you know, here's what's happening and here's why
Yeah.
we're doing it. And it takes time,
Yeah.
and now we got that done. And so now it's like, okay, now we can kind of get this out of the way and get back to work. So anyway, let me pause there. What I guess maybe, again, I feel
Let
uncomfortable talking about this topic, but what else should we be talking about on this as it
Yeah, I
relates
think
to other founders?
I think I'd like to try to talk a little bit about governance. So,
Oh yeah.
I know there were some conversations along the way in your process, and as much as you're comfortable sharing, talk a bit to folks about governance and what the folks that were investing were looking for, and how you weighed that with the way the current corporate structure was. Yours was a bit of a unique structure in terms of the number of partners that existed in Strata. But I think the part that's probably less unique is, what outside investors were looking for from the standpoint of board makeup and,
Yeah.
financial decisions going forward and hierarchy and that sort of stuff.
Yeah, yeah. And keep me honest here, just to make sure I'm
Mhm.
answering your question properly. So
Sure.
up until this point,
Wait,
we
do you
were
think
self.
I wouldn't keep you honest? Just
I don't.
if
Maybe.
anybody
Uh,
just tuning into the show, they may have missed that I'm keeping you honest for a couple hundred
that's right.
episodes now.
That's right. Yeah. So up until this point, we've been internally like self-funded, self-held. So we just
Mhm.
sort of answered to ourselves, the ownership team. So we didn't really. It was kind of like, hey, do you want to go that direction? Yeah, cool. All right, don't run out of money.
Right,
Like,
right.
it was probably a little bit more stressful than that, to be honest. But the point is we didn't have any outside interests. Like we could basically look at each other and basically say, okay, here's what we're thinking, here's what the risk would be,
Right.
and all that. But as you know, and as anybody would imagine, like once you raise money, those investors also want to know that they have a say in what's
Yeah.
happening. And so we never had a board up until now. We had, we were an LLC, or I guess we still are, but anyway, we were an LLC with just our managing members, and we would just look at each other and say, what do you want to do? But now we had to, we had to clean up our operating agreement. We've got a board now. I remember sitting down with one of our board members, and I don't know if he'll remember this, but we were sitting down at a meeting in Chicago over breakfast, and I don't remember how this came up, but I think I asked him in a roundabout way what he expected my relationship to be with the new board and vice
Yeah.
versa. And I I don't know if he'll remember this, but what I recall from that meeting in July was he was sitting there, we were having some omelets or something at some hotel, and he just said something like "Look, if we tell you too much about if we get too specific about how the business needs to be run, then we can't hold you it becomes harder to hold you accountable as a CEO." And so what he was basically alluding to as he kind of then continued on was this idea that, the board is there to, from a governance standpoint, is there to kind of help set the targets, make sure that we're investing in the right things to get to those targets.
Mhm.
But they're also there to help if some underlying assumption changes and we can't hit those targets. And so,
Right.
you know, I know this sounds like it's one thing for me to explain this. People that haven't gone through it are probably like, oh, whatever. I read that. That's how that works. but it's something else entirely to kind of go from, effectively years of self-management, self-governance to, okay, who are these people and what are their motivations? What are they thinking about?
Right.
And that's like I would say one of the harder things to kind of explain to people through this process is that, you know, it we went through this like courting process with a lot of different investors. And if you were to just put the term sheets up side by side, yeah,
Mhm.
you can look at the terms, but the much harder part of vetting this and picking the right partner is actually having these conversations and trying to figure out like, okay, we're in the honeymoon period now, but what are these people going to be like, 8 months from now when we miss a
Right.
key target or something like
Right.
that. So anyway, we do have a board now. We've got 5 seats on there. One of our key investors is on that seat,
Mhm.
is in one of those seats. We've got another industry guy in one of the seats, and we've got a third seat with somebody that we can't actually say their name publicly yet because of, I believe, some sort of lockup issue in another deal they're doing. But yeah, it's our first step into this. 3 of the 5 seats are taken right now. Actually, maybe 4. One of us will be the 4th seat. But anyway, the point is we've got a board now and it's new. I will admit openly that it's weird being on this side of the table.
Yeah. Yeah.
So, but from a governance standpoint, it's not like, it's well, let me pause there. Let's peel that back wherever you want to peel it back.
No, I think you're going down a good path here from, so like when you think about it from a governance standpoint. So you guys went from informal decision making to now a party of 4 or 5, and I would obviously say, it's a lot easier if you can fill the all 5 members out, so you've got the full contingent there. But when you think about that and going through this process, I think there's 2 pieces, and we talk about this a lot because we like priced rounds not just because of the certainty of what a company's worth, but because of all the other qualitative terms. And so you guys established a board of 5 people, but I'm curious how much time you spent talking about the hierarchy of the board, things like, what decisions are going to get to the board level, what are the spending thresholds that trigger a board decision, and how often you guys are meeting, and curious how long you guys spent on those sorts of things.
Yeah, I would say, oh man, that's a good question. I mean, I think there were probably a couple conversations around that, but
Mhm.
in the grand scheme of things, they probably weren't enough for me to even register in my head. Like I couldn't tell
Interesting.
you. I mean, I would tell you like maybe. See, like there was never, in my opinion, at least from where I sit, there was never
Mhm.
like a sit down moment of like, hey, let's talk about these 5 issues. It
Sure.
was really more like piecemeal,
Mhm.
where it was like, hey, what do you think of this? And then in a random conversation 3 days later, what do you think of that? And then
Right.
all of that eventually coalesced. So I'm not saying we didn't have those conversations, but I don't think it was like if you looked at my calendar, there was not a block of time that said, hey, we're going to talk about these terms. But let's just, and let's kind of go a little deeper on that. I will say I still stand by what I've said to other founders along the way. I think that if you're raising $1 million or less, you're probably better off not having a board. I mean, I know on the investor side that's uncomfortable, but if you're raising 1 million or less, you're probably so early that we don't know if there's product market fit. The cadence of having to do board meetings every month or even every quarter is probably more of a distraction. Just get back to work. In this particular case, again, we're talking about 25 mil. Now we got to be a little bit more careful about how we deploy the money and think about, where we're growing or where we're spending and stuff like that. So yeah, it's I was texting with one of my board members the other night on a layover. I don't remember how it came up, but he was like, he asked a really, I think, very succinct, very good question, and I admit I may have had, like, 2 glasses of wine already, and, he said, "Well, what do you think the plan is, or what does the plan look like to do X over the next 2 or 3 years?" And I responded back in a text, I said, "My man, it probably looks more like a bar fight than an MBA case study," and, I think he responded back with something like, "That's terrifying, but I like it." But again, like, I'm half joking, half serious. I think, you know, it this is a good thing, and I'll just speak for myself, not for the business here for just a minute. I like capital is not the problem. I mean, again, we've been really fortunate. We built a company, bootstrapped it, it was profitable. And I don't mean any disrespect to our investors, but like the capital itself wasn't really the issue. The issue is that like, and again, I'm just speaking for myself in my personal capacity here. look, I'm the CEO of a company in the healthcare space. I've never been a doctor. I've never had a practice. I have no real world experience with the struggles that our customers have.
Yeah.
And yet, we like, and yet we like, almost tripled revenue in the last, almost 2 years or whatever. And it's like, okay, brute force works, but now what does it look like to get even bigger? And so it's kind of like, one of the subjective qualities that I was looking for in this is who can kind of help us navigate this world where it sort of revolves around who's got the right letters after their name, and
Yeah.
credibility is based on how many years you've been seeing patients and stuff, which I'm not trying to make fun of. It's just that I was trying to hack for speed, and it was kind of like, okay, well, which one of these investors, putting aside even if you put the term sheets side by side, it's like, which one of these investors can also make us feel warm and fuzzy that they're going to help us build out a board that'll help us grow. And now this is the part you're probably not going to like, but I genuinely mean it. The easiest way for me to then suss out those subjective qualities was to be really, really clear about our vision and how we think about things.
Hmm.
Almost to the point where I think in some of these meetings early on, before we signed the term sheet, in some of these meetings early on, I would be meeting with these prospective investors, and I would say, look, 50% of my meeting here today is to inspire you to, want to join this thing. And the other 50% is to terrify you into running away and never talking to us again. And it's funny because it's true. The easiest way to kind of really get a sense for people is to really explain what they are or what you are. And so this is one of the other things I wanted to kind of share with everybody is that, like, you have probably experienced the same thing as me with early stage founders where there's a deck and they spend so much time putting this deck
Yeah.
together.
Yeah.
And then you sit there and you go through the deck or whatever. As I recall, I don't think I ever flipped through that deck with anybody. I mean, we made one,
Sure.
we distributed it early on. I think in hindsight, there were some points during the conversations with various investors or prospective investors where they might have pulled the deck up onto a screen share and say, what do you mean by this? Or what do you mean by that? But each of the meetings really was a conversation. And so, yeah, it was interesting. Like, a lot of the stuff we talk about at the early stage still applies even at this stage. And I don't know. It has just definitely been enlightening to kind of be on this side of the table here. So uh, we'll we'll see. Ask me again after a few board meetings. Oh, let's talk about that also, because you talked about cadence.
Yeah.
So I don't like the idea of every month, meeting every month, for
Right.
4-hour board meetings and dinners and stuff like that. So let me just start with what we've agreed on, and then we can talk about why if helpful. So we have 4 quarterly board meetings that are physically together, where we
Mhm.
will come together somewhere, whether it's
Yep.
our HQ or somewhere else. So we have 4 on the books now every quarter, for one every quarter. But I don't want to wait a quarter between meeting with the board members and getting that advice and all that stuff, because by definition, these board members are also busy. I can text them, but I want time. So for the months that we don't have meetings together, the other 8 months of the year, we have a 1-hour monthly business review, whereas like a pre-agreed upon deck. It's not
Mhm.
that formal, but it's a pre-agreed upon rough deck of like, hey, here
Mhm.
are the rough KPIs we should talk about.
Yeah.
Here's the format and all that. So that's kind of what we kind of settled in on is 8 monthly 1-hour MBRs and 4 quarterly meetups, where it's a 4-hour board meeting followed with probably a 2 or 3-hour dinner somewhere. So that's sort of what was right for us.
Yeah, and my personal preference, I like that monthly cadence in there. To your point, you can't have a 4-hour meeting every month and be effective. I mean, I guess there are certain companies maybe you can, but I think the key for me, and I mean every founder's got to find their own flow, but I think the key for me, both as a founder and as an investor, is to keep the communication flow going. And so if we're only having a formal conversation once a quarter, and you go off in a direction that I don't love, you probably get pretty far down that path. And I think, I think from a board, I think there's this phrase that they use for board activity: advise and consent. And I think when you talk about your monthly cadence of 8 meetings and your 4 quarterly meetings, I think the 8 meetings a year that are monthly, those are those advise meetings. Hey, Paul, I think you should go a little more in this direction. I think you go a little more in that direction. And then the 4 quarterly meetings are really more of the quote unquote consent. Hey guys, here's our quarterly spend on X, or here's what next year's budget is going to look like, or let's go out and fundraise. And so I think, just like I always promote with the founders in our portfolio that you should send a monthly email update to your investors, I do think it's important, if you have a board, to have that ongoing cycle of conversations, because I think it makes those quarterly meetings more productive. I'm more informed. Maybe I couldn't stop you, or maybe there wasn't a decision item in the January or February calls. But when March rolls around and we're in person, I can say like, "Hey, I've got this information from you over the past couple months. Show me how you're doing, and
Yeah.
then let's make some decisions."
Well, yeah, this might be a little bit TMI, but let me just share it anyway because it was eye-opening to me. Let me maybe share one example of a benefit I got from the board the other day,
Mm,
out of the blue. So I was driving the kids to school one morning. This is probably 2 weeks ago, 3 weeks ago, or something like that. I was driving the kids to school one morning. Sure enough, drop off the kids. Boom, flat tire.
uh,
So so here I am. It's like 8:15, 8:20 in the morning in Ashburn. And it was hot. I was sweating. I got my AirPods in, and here we go. I'm changing this tire on the side of the road. Phone call comes in, and I I was. I mean, you got to visualize it with me. TMI. I try to like stop. You know how in your AirPods it's like incoming call from
yeah,
whatever. Well,
yeah,
it's one of my investors. So, and I'm like, and hopefully he's not listening to this. I was like, oh God, right now, come on, man. And so I try to like, click to make it go away because I'm trying to change this tire.
yeah,
Traffic's going by. Sure enough, anyway, it picked up the call.
yeah,
And so he's like, what are you doing? I'm like, long story. He's like, you sound like hell. I'm like, I'm changing this tire. And I don't think he registered that. So he's like, hey, I just want to talk to you about something. Now here's like I thought there was like some interesting value that I didn't expect. He's like, hey, he had been on a couple email threads about something that we're doing internally. And long story short, he was like, hey, I just want to make sure we're on the same page. And I was like, in my mind, this all happened so fast. I was like, oh God, what now? What now? What? We're like 2 weeks post closing. Like, here we go. Honeymoon's over, bud. And so he goes, hey, I just want to make sure we're on the same page. And the way he said it was, he said something like, he's like, look, I just want to make sure that you're focused on what we've already talked about, which is like go to market and, revenue expansion, like all those things, like looking forward. And he's like, I just wanted to make sure we're on the same page because I just noticed in a couple of these emails that you're kind of like, you're saying yes too much to getting into like sitting in on these internal meetings.
mm,
Now that seems like, at face value, like whatever. Okay, cool. Right. But for me afterwards, like I think it was interesting because it was one of those things where even as an operator,
yeah,
it's one of those things you don't realize when you're in it and you're like, oh man, yeah, I've got the same finite hours a day as everybody else. And yeah, I want to be a team player and help my team and all that. But here was our board member saying, and investor saying, hey, I see you saying yes too much.
mm,
And I need you to just make sure he didn't say stop going to the meetings. He just said, I want to make sure we're on the same page, that going to market and focusing on growth are more important. And what he was alluding to is this idea, he didn't say it outright, but what he was alluding to was, hey, if you don't think you have the right people or enough people internally, then let's fix that.
yeah,
And that was like a weird kind of mental block. In fact, right after that, I actually ended up emailing a couple of the founders in my portfolio that have gone through something similar like this.
yeah,
And I just asked for like 20-minute meetings with them to say like, hey, how do you think about professional growth? What do you remember about this time going from this period to this period? And it's fascinating because it's one of those things like nobody ever talks about it. There's all these blogs about how to start. There's all these blogs about what happens at the exit, but
yeah,
nobody talks about the messy middle. Anyway, there's some value in there that I hadn't thought of because, these are people that are exited founders that have been there. I still will admit, I don't exactly know what to invest in. So for example, I wonder like, is there I mean, I hesitate to even say this, but like, should I have a therapist or a coach? I don't know.
yes,
because there's anyway, the point is though, is that there's this like weird messy middle that I kind of feel like we're in the middle of.
yeah,
And it's that transition from like bootstrapped and answering to ourselves now to like, it's weird. I'm rambling here, but it's weird. I don't feel that our vision has changed. In fact, like we've always been very clear about our vision. I
right,
don't think our potential has changed. But now all of a sudden, when you have a lot of money in the bank you and I talked about this about one of your portfolio companies a couple months ago. Now we're at this position where it's like everybody's like, put the money to work.
Yeah. Yeah.
And they're not trying to light it on fire, right?
Right.
But it's uncomfortable to us because we're always like, oh, are we gonna, what is our road? Are we profitable? Do we, what's cash flow gonna look like? And it's not like those board members aren't looking at it that way, but it's just weird to kind of, you've operated this one way for so long, and now it's kind of like, okay, how do we? Okay, all right. Sorry, one last thing. I'll be quiet about this. So I've been unpacking this. Clearly, you can tell I don't actually know how to articulate this. I've been unpacking this. So when I went to Florida this past week to kind of sit our leadership team down, in one of the riffs near the end of the meeting, I said something along the lines of like, look, I have two big concerns for the company as we go forward after this closing now. The first is we have to firmly but gently figure out how to like move the company from what is fast for a bootstrapped company that happens to be kind of slow for now an investor-backed company.
Yeah.
Right. And so it's like, how do you do that without losing our culture, without, churning employees and stuff like that? Like, how do you do that? I haven't quite figured it out, but that's like the first big, thing I gotta, I want to move forward with the leadership team. And I said, the second thing that I worry about is that with this pressure to like deploy capital, hire a bigger team, I have this like vague theory that every company has 3 layers to it. So the first is what I call the execution layer. These are the people that actually do the work. They're obviously very, very important, but they do the work. Then you have the impact layer. These are the people that direct the work, that whether it's me or our directors or managers or supervisors, like they are the impact layer directing the execution layer back towards whatever our strategy is. I love those 2 levels, but the part that scares me is, when you grow too fast, there's this third layer that I call the optics layer. And this is like, the easiest way I can explain it is we've all worked at a company before where there's a layer of people that don't actually do anything, or they just kind of focus on optics, how many meetings, how many people they manage, and I was saying to the team, I said, the second thing I really worry about is that we will accidentally introduce this optics layer, which is really problematic. And so I know it'll happen at some point because it always happens, but man, if we could just try to avoid that in any way, it's like, how do you keep the team lean, hungry? I don't know. Anyway, that's that. I'll leave it there. Let's unpack it wherever you want to go from there.
I actually think that's probably a good place to pin it for now. I think we could talk more about this. I'll just offer one comment on what you said, because I think it's something that I've said to founders a number of times. I think when you talk about creating that optics layer, and this is short form and it's a little bit cheeky, but if you have to think about what the title for an employee should be, you should really think about whether you need that employee at that stage of the company. Because if you're early on and you're trying to define the person, it's like, well, you shouldn't be. At that point, to your point, you should be very tactical, and it should be engineers and salespeople and support. Like, they should be very easy, definable roles. And if it's like, well, we need this big role that does all these things, man, I mean, you should really make sure that everything else is loaded and ready to go before you're adding those sorts of positions, because those sorts of positions can really enhance a culture, but they can also really disrupt the culture. Anyway, I really appreciate you digging in on a lot of this stuff. I think if people have questions, love to answer some of those on future episodes and have you dig in more. But I'm excited to see where you guys go next.
Yeah, I appreciate it, man. Well, I will commit this. Like, as much as I dislike fundraising news, we're just going to make this news one time, just because you only get to do it one time. And then everything is just right back to work and focused on how do we add value to customers and, and all that. So keep me honest here. My hope is this is our last fundraise ever.
You know what they say about the venture treadmill, though?
Well, I think we can, story for another time. That's the other reason for raising this amount, right? Yeah. Is to try to head that off. So we'll see where that goes. But anyway, I appreciate you poking holes in it. Let's see where it goes.
All right, man. Hope you have a great rest of the week.
Thanks, man. You too. See ya.